Vocabulary highlighted in the book Invest Like Warren Buffett, Powerful Strategies for Building Wealth by Kratter Matthew R. 1. You and I will never purchase an insurance company and invest the float. 2. Because of the size of this cash pile. 3. You and I can quickly buy almost any stock, without rumors swirling and moving the price of the stock. 4. Which we're sporting a lofty average P/E of 47. 5. We are free to learn from the best of Buffett's investment insights, while operating under the radar. 6. Buy shares in a few high-quality, well-run businesses at a fair price, and then hold them forever. 7. There seems to be some perverse human characteristic that likes to make easy things difficult. 8. I don't look to jump over 7-foot bars, I look around for 1-foot bars that I can step over. 9. Stocks are not just pieces of paper, or wiggles on a stock chart. 10. When you purchase a stock, you become a part owner in that business. After you purchase a stock, it may move up, or it may move sharply down. 11. For Buffett, the world is divided into two kinds of businesses, great businesses and everything else. 12. Time and money are too valuable to waste on researching or investing in a subpar business. 13. Staples are a commodity. Lots of different companies make them, but none of those companies really stand. 14. Manufacturing staples is a price-competitive business. The manufacturer that can produce them at the lowest cost will gain market share. 15. This is what a not-so-great business looks like. It produces a commodity product in a highly fragmented and competitive marketplace. 16. You can see that most manufacturers tend to be not-so-great businesses. 17. It is extremely difficult to become wealthy owning a price-competitive business. 18. I look for simple businesses, with consistent performance, and favorable long-term prospects. 19. Another way of saying this is that you are able to understand what the business does, and how it makes money. 20. Before you invest in a company, you need to understand the products or services that it provides. 21. I could never understand exactly what Enron did, which helped me to avoid it as an investment. It is easy to understand what Coca-Cola or Starbucks does. 22. Second, a great business usually has excellent brand recognition. 23. Great businesses occupy a significant slice of consumer mindshare. 24. Third, a great business sells products or services that never go out of style, and require very little updating. 25. Contrast this with a semiconductor company, which must reinvest most of its profits into research and development to produce the next faster chip. Those are profits which will not end up in the investor's pocket. 26. Ask yourself if the company was selling the same product 10 years ago, and whether it will be selling the same product 10 years from now. 27. Fourth, a great business will usually be one where the consumer needs to purchase the product or service again and again. 28. Car manufacturers and home builders are usually terrible businesses. 29. They are slightly addictive, candy, to extremely addictive, coffee, cigarettes, so much the better from the business owner's perspective. 35. A great business has pricing power, the power to raise its prices without large numbers of customers defecting. 31. Inflation causes prices to rise over time. Because Coke is such a unique product, the company is able to raise its prices right along with inflation, without experiencing any drop-off in sales. 32. The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. 33. Some businesses are able to raise their prices even faster than the rate of inflation. When this happens, it is a gold mine for the owner. 34. Business had untapped pricing power. 35. We never pay full price for our airplane tickets, but we always pay full price at Disneyland. 36. A great business always has a moat. 37. A price-competitive business, like a staple manufacturer, has no moat. 38. Simple, easy-to-understand business with strong brand recognition will be selling the same product or service 10 years from now. 39. Consumers need to buy the product or service again and again, able to raise prices with inflation, or even more quickly. 40. You are a beginner, there is an easy way to get started. I highly recommend the one-page stock analysis provided by ValueLine. 41. The nice thing about ValueLine is that they provide earnings per share for the last 16 years. 42. In addition, Value Line adjusts these earnings to account for non-recurring gains and losses. 43. Ford does not have smoothly uptrending earnings like Coke. Rather, earnings bounce around from year to year, and some years even show negative earnings, meaning that Ford lost money that year. As you can see, Ford is a not-so-great business, and it shows up in the financial statements. 44. A great business will have earnings that show a smooth upward trend. 45. It loses money on many of the cars that it sells, especially during recessions, while Coke never sells its products at a loss. 46. A great business will show a consistent return on equity, ROE, above 20%. 47. You can figure out a company's net worth, or shareholder equity, by adding up its assets and subtracting its debts, also known as liabilities. 48. If you own a company that has a net worth of $100 million, would you be happier if it earned $5 million per year, or $20 million? Clearly the latter. 49. A business with a higher ROE is a business that operates more efficiently, or is able to extract more profit from every sale. 50. If the ROE is consistently above 20%, it is very likely that what you are looking at is a great business with a moat. 51. There is one exception to this rule. Sometimes a company will borrow lots of money, take on debt, in order to boost its ROE. The more money a company borrows, the riskier that company becomes. 52. A great business will show a consistent return on total capital greater than 15%. 53. Fortunately, Value Line calculates both ROE and ROTC so that you don't have to. 54. As required for a great business, the ROTC for Coke is consistently above 15%. 54. Buffett typically invests in companies where the long-term debt could be paid off using 4 years or less of net profit. 55. Any way you slice it, Ford is not a great business, while Coke is. 56. A great business pays a dividend and or buys back stock. 57. A young great business is often better off plowing its earnings back into the business, in order to keep growing. 58. A dividend is simply a cash payment to shareholders. 59. Coke is simply an amazing economic engine that churns out mountains of cash. 60. We want to own businesses that drown us in cash. 61. Earnings show a smooth upward trend. Consistent return on equity, ROE, greater than 20%. Consistent return on total capital, ROTC, greater than 15%. Long-term debt less than 4 times earnings. Pays a dividend and or buys back stock. 62. If you paid $100,000 for the black box, and it returned $1,000 to you every year, you would have an investment that has a yield of 1%, 1,000/100,000. 63. Is 1% a good yield? Well, that depends. Chiefly, it depends on where interest rates are. 64. When you purchase a stock, you are buying partial ownership in a black box. This black box also happens to be a public corporation that makes and sells products to the public. 65. This is often referred to as the earnings yield of a stock. You can calculate it in one of 2 ways: earnings per share divided by the stock's price per share, or net profit divided by the market cap. 66. Coke is little bit like a bond, but with a yield that should grow over time. 67. The next time you hear the P/E of a stock, try flipping it over to see what its earnings yield is. 68. Microsoft started with a high P/E, grew its earnings strongly, and yet the stock went nowhere for a decade. 69. The lesson? Be very wary of paying a high P/E for a stock, even if it is a high-quality company. 70. So how much should you pay for a mature, slow-growing, high-quality business like Coke? That depends on what earnings yield you are content with. 71. Of course, Coke's growth could be faster or slower over the next decade. Ultimately, this kind of analysis is more art than science. 72. If you purchase a great business at a good price and hold it for 25 years, the dividend yield on your cost should also be quite high. 73. A simple rule dictates my buying: be fearful when others are greedy, and be greedy when others are fearful. 74. Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. 75. The easiest time to buy a great business at a great price is during a bear market. 76. All that it required was nerves of steel to buy when it appeared that the financial world was ending. 77. How long into a bear market should one wait to buy a great business? One method is just to wait for the dividend yield to get to 4%, or the trailing P/E, calculated using the company's last 12 months of earnings, to get to 15 or lower on a stock like Coke. That is the valuation method. 78. The second method is the market timing method. It involves waiting a fixed period of time into a bear market before buying, or waiting for a large peak to trough drawdown in price. 79. In other words, it fell roughly 58% from peak to trough. 80. Since Coke is a blue chip stock that is included in indices like the Dow Jones Industrial Average and the S&P 500, it tends to bottom at the same time that the general stock market bottoms. 81. That is the time you want to be loading up on businesses like Coke. 82. Time like this will come again. 83. If you raise your cash levels now, you will be ready. You will have the cash available to buy great businesses like Coke during the next bear market. 84. The best way to learn about investing is to start doing. 85. There's no better way to learn than simply by doing.